manager at Dynamic Funds. Rose, thank you very much for coming in.
Thanks for having me.
So how does all this look to a fixed income portfolio manager?
Listen, we're having unprecedented moves, especially in the last 2.5 days. It's not like there's economic data to back these types of moves up. So you have to take a step back and have to think about why are bonds moving the way that they are. It could potentially be a liquidation happening. Doesn't make sense to buy and or hold and or add. We can't really say what happens tomorrow, but we can say historically what has happened. So, long bonds, for example, have moved 56 basis points in the last 2.5 days. When was the last time that has happened? Basically since when they're 14%. So you have to think to yourself, these types of moves don't really happen. Perhaps maybe if I don't own enough bonds, I am questioning what happens to the economy in the next 6 to 9 months. The U.S. has to refinance about $6 to $9 trillion of debt. Where am I betting? Where am I putting my money? Maybe I should start pairing into this. So,
Ryan.
Up until very recently, the expectation was the Bank of Canada was going to cut more than the Federal Reserve. Now, very recently, you're starting to price in a lot more cuts from the Fed. Like the Canada-U.S., how you're looking at that. Do you see more opportunities in Canada, or are you looking more to the U.S.?
With these types of moves, every day changes. With Canada in particular, though, we are looking at potentially, a new leadership coming in or the same. But what's really important is, will it be a minority or a majority? Because that could really change the policy stance, and we could really start spending in this country. Already what's forecasted for supply in Canadian government bonds is pretty much where we were in COVID times. So if we even have a boost in spending, we could even see more supplies. So that could mean a backup in yields in Canada. So when I look to myself and I say, Canada or US, with this backup in US, it could give you the opportunity to buy US, kind of stay where you are in index in Canada and see what happens with policy. So it's giving us a little bit of a leverage here.
You've made some recent comments on the expectation that countries will spend more on defense as they're being pushed to do by the United States. There's been a big move in Germany where I think they've agreed on more relaxed debt limits in Germany for the purpose of spending on defense. Canada is expected to spend more on defense as well. What are the consequences to the bond market from those expectations?
What was another unprecedented event was, German bonds moving 30 basis points in one day a few weeks ago when you're talking about what happened with the vote. Could that potentially happen in Canada, or could there be another Liz Truss moment in Canada? I'm not sure, but I can tell you that, spending on the policy side probably will go into, higher levels versus low. And will the supply be taken down by our market? Our market is smaller than the U.S., so it really is something that we're monitoring right now, and we could take that opportunity.
For us in our portfolio, so we're a balanced investor. Not sure if you caught the earlier segment. And in our fixed income sleeve, late last year when the Treasury hit 5%, we got out of credit. A big position went more into U.S. Treasuries, feeling pretty good about that play here. Going forward, are you looking more in the credit because the credit spreads are kind of expanding a little bit, or are you saying let's lower risk, stick with Treasuries right now?
Yeah, no, that's a fantastic question. For corporate bonds, right now we have seen the spread widen out, 40 to 50% versus where they were at the beginning of the year. So we tell ourselves, as active managers, do we start stepping in or more, et cetera? So we think, having the fundamental research behind you to really make those calls, to say, look at those corporations that, can withstand potentially a large slowdown in the future, those have the value when spreads have backed up 40 to 50. So yes, we are still stepping in to buy. There are ways where you can hedge out more of the macro credit risk that we're looking at. But in terms of the corporations that we like to hold as active managers, we're definitely stepping in to buy.
Do you ever use bond ETFs?
We do.
What kind should investors be looking at now?
We look at all kinds. Right now, looking at U.S. Treasuries, we have our own ETFs, active ETFs that we're promoting right now that do have the leverage to go into the U.S. DXBB, DXB. So those types of ETFs on the active side would be mostly promoted.
What kind of U.S. bonds do they hold, those ETFs?
Those hold corporate U.S. bonds as well as U.S. Treasuries.
What about the stagflation fear that a lot of people have right now? Rising inflation and slowing economic growth at the same time. What are the consequences for the fixed income market?
Definitely, we think that in the short term there is a lot of pressure there. But when you look at tariffs and what the long-term goal is of a tariff, or what could potentially do to an economy, it's long-term deflationary. We think so that you can see short-term inflationary pressures, but we think on a long term it does come down. So does stagflation stay here? That's what we're trying to look at every day, and we don't think it does.
I'm personally thinking maybe a little too early to step into, say, high yield. We haven't seen that kind of massive widening of the spreads. But if I'm thinking, Wayne Gretzky, where is the puck going? Not where it is right now. So if I'm looking out, if we do go through more, tougher economic times, maybe we reduce our treasuries and buy those beaten up high yields. Or what's your thinking on that?
Yeah, definitely agree with you. I should have said, investment grade is where to be right now. High yield, when we look at spreads, starting the year at 300, it's kind of backing the 450. Above 500 starts to make some sense to us. When you look at other financial, in the financial crisis, it got to 1,000. So we have to think to ourselves, where do you start pairing in? But I tend to agree with you. It's not the time right now, but it will be.
Maybe north of 600 on a spread. And just for our viewers, basically that is the spread over U.S. lower risk government yields. Once they get really high, essentially they're cheaper.
Exactly.
Rose, thank you very much.
Thank you so much for having me.
Rose Devli is a portfolio